silver is going to go in the very, very end, of that cycle in the hundreds, maybe even the thousands. I don't know. It depends. These numbers don't really mean anything when the dollar doesn't buy anything. So it's anyone's guess, but I do think that the ratio, at least briefly, will fall to 15-1, which is what I'm waiting for. And when that happens, I'm just going to buy a bunch of stuff with silver, and whatever I can't buy, I'll just convert back into gold. I think when the next printing round starts, this is going to be after the next repo crisis, and the Fed's going to have to say, look, we're going to have to cut back down to zero, or we're going to have to cut 100 basis points overnight. I think then the premiums are going to start to rise again, and people are going to start really getting nervous about the dollar, and who knows where we're going to be with the elections, or if there's going to be court cases and riots in the streets.
Because the white metal is currently worth around 1/86 the price of gold, buying silver bullion is affordable and stands to see a much bigger percentage gain if the silver price goes up. In fact, silver has outperformed gold prices in bull markets. An investor can hedge their bets with silver bullion in their investment portfolio. Renowned market analyst Rafi Farber underscores that silver's significant movement began in 2010, often trailing financial players' actions. He predicts a surge in public interest could push prices to new heights, potentially lowering the silver-to-gold ratio to 15-1. Analysts expect additional stimulus actions, given that current measures may not be sufficient to reach the projected 4.8% growth rate this year. Since China is a primary silver importer, any economic turnaround will likely boost silver demand, especially for industrial purposes. This trend mirrors the rise in silver prices in 2011, supported by China's growth. From a technical perspective, Rafi notes the surprising stability of gold prices, which haven't corrected in months, despite his expectation of a drop of up to $100. Drawing parallels to 2008-2011, he suggests a potential for a similar bull run despite current market challenges. Meanwhile, money managers have increased net long positions in gold, while investors have added to exchange-traded fund holdings in recent sessions. SPDR Gold Shares, the world's largest bullion-backed ETF, registered the biggest weekly inflow since March. Gold futures may rise to an average of $3,000 in the fourth quarter of 2025, Commonwealth Bank of Australia analyst Vivek Dhar mentioned. In his assessment, Rafi notes that in 2010 and 2011, physical silver coins were briefly traded at a discount to ETFs, signaling a derivative-based bubble. Currently, premiums are around 6 to 7%, and demand for physical silver persists. He suggests that interest will surge again during the next monetary easing, driven by rising concerns about the dollar. If demand is high, premiums can go up fast, making purchasing physical silver bullion more expensive and a less attractive investment. Now, we present the clips of Rafi Farber's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
What's surprising to me is that gold hasn't had much of a correction for how long has it been? I don't even know. It's been months. On the one hand, I'm emotionally ready for a correction. If gold were to go down 50, 60, 70, even $100 in some kind of little crunch, it wouldn't surprise me, but it's not happening. And I looked at the commitment of traders in gold, right? And the worrying thing is that the bullion bank short positions are very near a record high in gold. But what I also noticed is that you go back all the way to 2008, 2009 to 2011, the strongest portion of the gold bull market of that era was after the 2008 crash, right? And then gold goes something from 642 to 1923. What was it? From October 2008 to September 2000. So about 3 years. It goes from more than triples, about triples. And in those 3 years, the COTs, the commitment of traders, who's positioned what in the futures market, if you trust those numbers, I don't completely trust them, but I think they're basically accurate. Maybe they look very similar to now. And for most of those 3 years, the bullion bank shorts were at or near records for 3 years. So I'm saying we're in a dangerous position where you could get people knocked out especially if they're in leverage or doing some kind of crazy trading strategy with options, which I never ever recommend. But those people could get kicked out if they're just trend followers or if they're hedge funds or something. But then again, we had 3 years of this from 2008 to 2011, so we could have that again, and we could just keep going higher from here, just like we did in those years. I'm not going to try to play it. With silver, silver didn't really make a move until 2010, 2011. So 2008, 2009 didn't do that much. Same thing in the 1970s, like from 1975 to 1979, silver did basically nothing. And then all of a sudden, 1979, 1980, the last half of 1979 into the first 3 weeks of 1980, silver just goes crazy. That's a signal of the public finally waking up, right? The banks wake up, the financial players who see a little bit deeper what's going on in the derivative system, they make their moves in gold before the public finally wakes up. What makes the public wake up? Well, not the derivative markets, the supermarkets. That's what makes them wake up. Then they go for silver. So we're going to see that at the very, very end. Where silver is going to go in the very, very end, of that cycle, in the hundreds, maybe even the thousands. I don't know. It depends. If you look at the premiums in 2010, 2011 for silver, junk silver, like the quarters, dimes, half dollars, those kind of 1964 and earlier, they were actually below zero. It means it was cheaper to buy physical silver from I don't know specifically Miles Franklin, but a retailer in a coin shop than it was to buy SLV. Briefly in 2011, like let's say when silver was like going from 40 to 50. So for like a few months in that time span, it was cheaper to buy physical coins. That's a sign that silver was in at least a derivative based bubble, right? It was the hedge funds and whoever buys ETFs and futures, they were chasing the silver price higher, or they were caught in some kind of spiral, and it wasn't being reflected in the physical markets. Now, premiums are low, but they're still positive. It's still, it still costs a premium. I think it's like 6-7% for junk silver, which means that there's still some demand in physical markets. So it's not like buyers have totally given up and they don't even want it, right? Which was the case in 2011 briefly. When do the retailers or the stackers come in again? I think when the next printing round starts, right? This is going to be after the next repo crisis, and the Fed's going to have to say, look, we're going to have to cut back down to zero, or we're going to have to cut 100 basis points overnight, something like that. I think then the premiums are going to start to rise again.
According to New York Fed data, demand for the Fed's overnight reverse repurchase agreement facility, or RRP, dropped on Tuesday to $238 billion, the lowest since May 2021, from $261 billion the prior session. It's the latest in a string of declines since usage of the RRP spiked in late 2022, drawing into question the outlook for the central bank's balance sheet runoff. While Rafi Farber remains agnostic about these theories, he asserts that any new round of monetary easing will likely drive up gold and silver prices. He emphasizes that today's issues may be twice as severe as in 2019, marked by record short positions in 2-year Treasury notes, signaling growing financial instability. The overnight reverse repo facility has been at low levels, which has raised concerns about a potential liquidity crisis in the financial markets. The Federal Reserve has been shrinking its balance sheet since June 2022 through quantitative tightening. In a historical context, Rafi notes that current market conditions reflect those leading up to major crises, with geopolitical tensions and economic instability setting the stage for potential upheaval. Let's get back to the interview.
There are theories as to, the repocalypse happens in September 2019. The pandemic was technically, from a biological perspective, already happening at that point. People were being infected. It was spreading. It just didn't make the big news yet. And then, by January, February, which is the repos were ongoing. I have to check the chart, but I think it was like tens of billions of dollars a day. And the balance sheet was going back up. But some people say they needed an excuse to print money more directly. And so shutting down the world might have contributed to that desire to do that, to stabilize the monetary system, but give an excuse to do that. That it's possible. A lot of people are very insistent that that's what the truth is. I'm just going to maintain an agnostic stance on that, because there's nothing I can do about it, whatever happened. I don't know. I just know that when you print more money, gold and silver are going to go up eventually. And one more, and my thesis is one more printing round, and it's going to happen. So if it's interesting, because we can really test that theory in a few weeks or months, right? We know the reverse repos are going to run out. We know that once that happens, bank reserves are going to fall. The Fed admits this explicitly in their papers, right? They say this bank reserves are going to fall, and then we're probably going to have to slow down QE. They say this. It's clear. It's obvious even to them. If the pandemic was related in a monetary sense to the repocalypse of 2019, we should see something like that happen again, some other excuse to pop up to print trillions of dollars to alleviate the monetary tightness that the repocalypse is a symptom of, right? It means that there's other problems somewhere, but the repo is just one symptom of it. So if it's true, if they're right, then I don't know, God forbid it would be a big war. I mean, the stage is definitely set in the world for that, and we see it everywhere. We could have some election problems in the United States, some riots on either side, depending on who wins and who loses and who accuses who of cheating. This is all primed to explode, and we know it. I mean, imagine living like in 1914, right before Franz Ferdinand was assassinated, and then World War I breaks out. I mean, I'm not saying that World War III is going to break out like in a few months, but we're in the same sort of situation where the chess pieces have been aligned on different sides, in politically, geopolitically, in the Middle East, China, Russia. It's all ready for something to happen. We don't know what. I don't know exactly how much bigger it is, but the reason I say that is that if when the mainstream media, I mean, I guess the decent parts of the financial mainstream media, like I'd say the upper class of it, like FT, and they get more academic and more deep into it. They have some good writers there. When they were talking about the basis trade that's being funded by repo, and they started like getting nervous about it, they were talking about 2019 and the apocalypse, and they were looking at the volumes in the 2-year treasury. For some reason, the 2-year treasury has the highest liquidity. So most hedge funds, when they want a basis trade and to snip that little penny off of the difference between the futures and the spot, most of them pick, or a big proportion or a plurality of them pick the 2-year. When FT was reporting on this, the amount of shorts in the 2-year treasury note were at records at the time. And then they said, oh, don't worry about it. It's going to go down now. The basis trade is out of style and everything will be fine. It's worse than 2019 now, but it's going to go down now. That's what they were saying in their tone. I don't know how they proved it, but they were wrong because now it's at even bigger positions. I forgot the number, but it's an all-time record high, and it's twice the amount of the basis trade in 2019, which was funded by the same repo dollars. Right, so I'm extrapolating. If the 2-year basis trade short is twice as big as it was in 2019, then the problem, at least from that perspective, is at least twice as big. It's probably bigger than that.
When individuals invest in physical silver, they are reassured that the metal's value will continue to persist. Global experts predict silver may reach $48 due to geopolitical issues and elections. How do you perceive the interplay between ongoing crisis and precious metals investments in shaping future market dynamics? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.